Despite the positive close on the last trading day of the month of May, the NGX All-Share Index was down 3.5% in the month of May. And will the bears continue to hold sway in the month of June? We have Ukadike Chinma. She's a senior analyst at Vetiva. She joins us now for this discussion. Thank you so much for your time on the show today. And let's first get into what we're seeing play out there, what played out in the month of May, and what are your expectations for June? Do you think the bears are still going to hold sway?
Thank you very much for having me. Yes, for the month of May, what we saw was that in the beginning, we saw investors react quite positively, slightly positively to the earnings releases, the Q1 earnings releases from many of these companies. We saw, like GDP pointed out, we saw some economic recovery. So we saw that play out in many of their results. And so the investors kind of rewarded them for those performances. But we quickly saw that revert. We saw mixed markets mostly, but the overarching thing was that the bears were in session. And what we then saw was that many of the equity investors then started reverting to the fixed income markets, due to the higher yields in the markets. And as such, we saw that affect the equity markets adversely. Also, we know that the FX liquidity was a bit better in that month or in this month, and we saw that many of the FPIs that were trapped somewhat were able to then offload from the market. We also saw the oil and gas sector really favored, mostly Seplat, and we think it was because of the dual listing of Seplat in the NGX here and also in the foreign stock exchange, and we think that investors were able to use that to leave the Nigerian market. So for the rest of June, we don't think anything significant is really going to happen to change the sentiment that we've been seeing so far. Although, say for maybe at the end of June, which will signal the end of the quarter, where we see some portfolio rebalancing. But aside that, we think the bears will still continue to sway the market. Beyond that, we'll be seeing quarterly the Q2 results or the H1 results as applies to different companies. We'll be seeing their results for the end of this quarter, and because we think we'll see positive results, especially for the consumer goods sector, we think that investors will once again come in positively into the market. But aside that, we think that the overarching theme in the market right now is that the bears would hold sway.
All right, then let's get into how investors are, marking the field here. We're seeing that PFAs are more or less moving towards the bonds market and even bank placement and over the equities market. What's at play and what do you think is driving this?
I'd say it will be the yields in the fixed income market. So around last year, we all saw what happened between Q2 and Q3 in 2020. We saw how investors moved from the fixed income market and flooded the equity market, and we saw that the NSE ESI at the time, the NSE ESI closed about 50% up year to date for the whole year, which was the best performing ESI, the best performing stock market globally. However, from the beginning of this year, we've been seeing a return to fixed income yields, an increase in fixed income yields, and we've been seeing the gradual shifts. We have been seeing the gradual shifts back to the fixed income market from the equity market. So that's what we think has been happening. Right now, yields are around rates are around 9%. At the last auction, NTB auction that was held, I think last week, the 1-year T-bill closed at about 9%, if I'm not mistaken. And with the government's bond plan that we are expecting, we think that yields will continue to rise in that market. So I think that is what has really been driving the move from the equity markets into the fixed income markets. And yeah, that's basically.
All right, Chima, but very quickly before I let you go, just want to get your expectations for the sectors. Let's look at the banks.
I think the banks will perform relatively well. We've been seeing increased interest rates over this quarter, from OMO to NCBs and even in bonds. And we expect that the banks will take full advantage of that, especially as we're coming from a period where banks had previously seen lower interest rates. So I think we'll be seeing a very positive performance from the banks. Also, we're seeing that now that we're seeing economic recovery across the economy, we expect that we will not see as much impairments on loans as we had been seeing as we had seen in their full year performance or in Q1. So I think that will be a positive performance to expect from the banks. For the consumer goods sector, we can't see that there's a lot that has been happening. If we look at the sugar sector, we look at the food sector, we look at the brewery space, and just look at their Q1 performance, we can see how that has really improved, especially when we compare to their previous year's performance. And Q2 for last year was a very, very terrible year for many of these companies.